Have you noticed how two simple economic reports released just minutes apart completely changed the outlook for gold? At first glance, neither number seemed dramatic on its own. But when investors connected them, they revealed something far more significant, something that has historically fueled some of gold's strongest rallies. And the market reacted immediately. Gold surged above $4,100, reaching nearly $4,130 for the first time in 2 weeks, while silver hovered around $58. The question is, why did gold respond so aggressively, and why is silver moving more cautiously? More importantly, what could this mean for precious metals through the rest of the year? Stay with me, because the answer could influence every major move between now and the next Federal Reserve meeting. Welcome back to AgJohn Silver Update, where we break down the biggest economic developments affecting gold and silver in a way that's easy to understand, whether you've been investing for years or you're just getting started. If you're new here, consider subscribing and turning on notifications, because the weeks ahead could be some of the most important we've seen for precious metals investors this year. Before we begin, remember that everything shared in this video is strictly for educational and informational purposes. It should never be considered financial advice. Always do your own research and consult a qualified financial professional before making investment decisions. Now let's look at what happened this morning. Gold futures opened around $4,060 before quickly climbing after fresh economic data was released. Within minutes, buyers pushed the price to roughly $4,130, breaking through a resistance level that had capped prices for nearly 2 weeks. Since the middle of July, gold had repeatedly struggled to stay above $4,100, making today's breakout especially important from a technical perspective. Silver followed a different path. It opened just under $58 before recovering to approximately $58.24, but it still remains below the psychologically important $60 level. That difference isn't accidental, and later in this video we'll explain exactly why silver is behaving differently, even though both metals usually benefit from the same macroeconomic environment. The move began when the U.S. Bureau of Economic Analysis released two key reports at exactly 8:30 a.m. Eastern Time. The first showed that the U.S. economy expanded at an annualized rate of only 1.5% during the second quarter of 2026. While growth remained positive, it slowed noticeably from the previous quarter's 2.1% pace. Even more important, economists had expected growth closer to 2.3%, meaning the actual result came in well below forecasts and immediately changed expectations for the Federal Reserve. To understand why this matters, it's helpful to remember what GDP actually measures. Gross domestic product represents the total value of all goods and services produced across the economy. Strong GDP generally reflects healthy consumer spending, business investment, hiring, and overall economic momentum. When GDP begins losing speed, it often signals that businesses are becoming more cautious, investment is slowing, and economic activity is beginning to cool. Today's report painted exactly that picture. Consumer spending remained relatively resilient, and exports improved compared with the previous quarter. However, weaker government spending and trade-related factors pulled overall growth lower, suggesting that the slowdown isn't simply a temporary fluctuation. Instead, it points toward broader economic weakness that could continue over the coming months. At the same moment, another report delivered an equally important message. The Federal Reserve's preferred inflation measure, the Core Personal Consumption Expenditures, Core PCE index, showed annual inflation still running at 3.3%. Although monthly inflation increased by only 0.1%, slightly below expectations, the yearly figure remains far above the Fed's 2% target. That means inflation has refused to cool meaningfully for several consecutive months. While price pressures have eased compared with previous peaks, they remain stubbornly elevated, making it much harder for policymakers to declare victory over inflation. And when you combine these two reports together, they reveal exactly why investors rushed toward gold this morning. When investors looked at both reports together, the bigger picture became impossible to ignore. Economic growth is clearly slowing, yet inflation remains well above the Federal Reserve's target. That combination has a name that every serious precious metals investor should understand: stagflation. Throughout modern financial history, this has been one of the strongest environments for gold. Let's break down what that really means. Stagflation combines two difficult economic conditions happening at the same time. On one side, the economy loses momentum. Businesses become more cautious, hiring slows, investment weakens, and overall growth fades. On the other side, prices continue rising, making everyday goods and services more expensive while reducing consumers' purchasing power. Normally, central banks have tools to manage one problem or the other. When inflation gets too high, they raise interest rates to cool demand. When growth weakens, they lower rates to encourage borrowing and investment. But when both problems exist simultaneously, those traditional solutions begin working against each other. If the Fed raises interest rates to fight inflation, borrowing becomes more expensive for families and businesses, placing additional pressure on an economy that's already slowing. But if policymakers reduce rates to support growth, they risk allowing inflation to become even more persistent. In other words, every option comes with serious consequences. This is exactly why markets become increasingly uncertain during periods like these. Investors begin questioning whether policymakers can successfully balance both objectives, and that uncertainty often pushes money toward assets that have historically protected purchasing power. Gold has repeatedly served that role over many decades. History offers an important lesson. During the stagflation period of the 1970s, inflation remained stubborn while economic conditions weakened significantly. Throughout that decade, gold experienced one of the strongest bull markets ever recorded, climbing from roughly $35 per ounce in the early 1970s to more than $800 by 1980. Meanwhile, many traditional investments struggled after adjusting for inflation, and cash steadily lost purchasing power. That doesn't automatically mean today's market will follow the exact same path. The global economy is very different now, financial markets are more advanced, and central banks have access to more policy tools than they did decades ago. However, the underlying challenge facing policymakers today is surprisingly similar. Slowing growth combined with sticky inflation creates difficult decisions, and gold appears to be recognizing that possibility before many investors do. That helps explain why today's breakout above $4,100 attracted so much attention. Markets aren't simply reacting to one economic report. They're responding to the growing possibility that the Federal Reserve could soon find itself trapped between supporting economic growth and continuing its fight against inflation. Now attention shifts towards September's Federal Reserve meeting, where officials will once again decide whether interest rates should remain unchanged or move higher. Before today's reports, markets were assigning roughly a 77% probability that another rate increase could arrive in September. But these latest numbers have complicated that outlook considerably. Inflation remains well above the Fed's target, giving policymakers who favor tighter monetary policy a strong argument for keeping pressure on prices. At the same time, the unexpected slowdown in GDP raises serious concerns about tightening financial conditions while the economy is already losing momentum. That internal debate has become increasingly visible inside the Federal Reserve itself. Recent meetings have revealed growing differences among policymakers regarding the best path forward, showing that there is no unanimous agreement on how to respond to the current economic environment. Because of that uncertainty, every important economic report released between now and September carries much greater significance than usual. Inflation data, employment numbers, and consumer spending reports will all influence expectations surrounding the Fed's next move, and that uncertainty itself continues supporting gold. Whenever investors struggle to predict central bank policy with confidence, many choose to increase exposure to assets that historically preserve value during periods of economic instability. That's why today's move in gold wasn't simply about one morning's economic data. It reflected growing concern that the Federal Reserve's biggest challenge may only be beginning. No matter which way you look at today's data, one thing becomes very clear: the next several weeks could shape the direction of both gold and silver for the rest of the year. Let's consider the three outcomes investors should be watching most closely. The first possibility is that incoming economic reports continue showing weaker growth while inflation gradually eases. In that situation, the Federal Reserve would have a stronger reason to leave interest rates unchanged. If markets begin believing rate hikes are off the table, the US dollar could soften, Treasury yields may ease, and gold would likely have room to extend today's breakout. A sustained move above $4,200 could then open the door toward even higher price levels. The second scenario is a September rate hike. At first, that could pressure gold. Higher interest rates generally strengthen the dollar and temporarily reduce demand for non-yielding assets like precious metals. A short-term pullback toward the $4,000 area wouldn't be surprising, but history suggests that such weakness may not last. If the Fed tightens policy while economic growth continues slowing, investors could quickly begin worrying about recession risks. Those concerns often bring safe haven demand back into the market, allowing gold to recover after the initial reaction. In other words, even a rate hike may create only temporary weakness before longer-term buyers return. The third, and perhaps most balanced outcome, is that upcoming economic reports deliver mixed signals. Inflation could remain stubborn while growth stabilizes just enough to keep policymakers waiting for additional evidence. In that case, the Fed may hold rates steady while signaling that future decisions remain completely data-dependent. That environment would likely keep gold trading within a broader range, allowing prices to consolidate recent gains before making the next significant move. Sideways action isn't necessarily bearish. Often, it's simply the market building a stronger foundation before another advance. Now let's shift our attention to silver. Many investors are asking the same question today. If gold has already broken above resistance, why is silver still struggling below $60? The answer lies in silver's unique role. Unlike gold, silver isn't only a precious metal. More than half of global silver demand comes from industrial applications, including solar panels, electronics, semiconductors, electric vehicles, and many advanced technologies. Because of that, weaker economic growth naturally raises concerns about future industrial demand. That's one reason silver hasn't matched gold's immediate strength. However, the bigger picture remains extremely important. According to the latest World Silver Survey, global silver demand is still expected to exceed mine supply for another consecutive year, extending a long-running structural deficit. In simple terms, the world continues consuming more silver than producers are bringing out of the ground. Deficits like that don't disappear overnight, and eventually inventories become increasingly difficult to replace. That's why many institutional analysts remain optimistic despite recent volatility. Another indicator worth watching is the gold-to-silver ratio, which currently remains above its long-term historical average. When this ratio becomes elevated, it often suggests that silver is relatively undervalued compared with gold. Historically, once silver begins catching up, its rallies have often been faster and more aggressive than gold's. From a technical standpoint, the $60 level remains the key line in the sand. A convincing move above that price could signal that silver's correction has ended and that buyers are regaining control. If that happens, the next important targets would likely fall in the low to mid-60s, with stronger momentum potentially carrying prices even higher over time. So what should investors take away from everything that happened today? The latest economic reports revealed an economy that's losing momentum while inflation refuses to return to the Federal Reserve's comfort zone. That combination has created one of the most challenging policy environments in years, and markets immediately recognized what it could mean. Gold responded by breaking above an important resistance level, while silver continues building what may become a much larger move once industrial concerns begin fading. Now all eyes turn toward the next major economic events, including upcoming inflation reports, the Jackson Hole Symposium, and the September Federal Reserve meeting. Each of those could significantly influence expectations for interest rates and, in turn, the direction of precious metals. I'd love to hear your opinion. After seeing today's GDP and inflation numbers, do you believe the Federal Reserve will raise rates in September? Or will policymakers choose to wait? Share your thoughts in the comments because thoughtful discussions always help this community better understand what's happening in the markets. If you found today's analysis valuable, don't forget to like this video, subscribe to AgJohn Silver Update, and turn on notifications so you never miss our daily breakdowns of gold, silver, and the macroeconomic forces shaping the financial world. Thank you for watching, stay informed, stay disciplined, and I'll see you in the next video.